In this learning objective, we describe and illustrate merchandising operations and the two types of inventory systems. So a merchandiser is a company that will buy a pre-manufactured or pre-built product, increase the price, and then sell it to the consumer. So a merchandiser is not manufacturing or making these products. They simply buy it and then resell it to the consumer. So businesses that sell a product are called merchandisers because they sell merchandise or goods to customers. Merchandisers have an additional asset called merchandise inventory that service companies do not need. The term merchandise is usually dropped, and it's usually simply referred to as inventory. Now, inventory is defined as the merchandise that a company holds for sale to customers. So while it's on our shelves, it's called inventory. And then once it's sold, we lower inventory and transfer the cost of that goods to an expense account called cost of goods sold. So let's look at cost of goods sold and some of the other new accounts that merchandisers have. So merchandising consists of buying and selling products rather than services. Merchandisers will obviously have some new balance sheet and income statement items. On the balance sheet, the new account is called inventory, which is an asset. It's an asset because the inventory, by definition, hasn't been sold yet. And because we hope to sell it in the future, has a future benefit or a future value, so we consider it an asset. And because we intend to sell it within the next 12 months, it's considered a current asset. Now, over on the income statement, the revenue account is no longer to be called sales revenue. When we sell a product, we're going to call it sales revenue or just simply sales. In addition, merchandisers have an expense account called cost of goods sold. So when the product is sitting on our shelves, it's the cost of that product is in our inventory account, which is an asset. As soon as we sell that inventory, we lower the inventory and transfer the cost of that inventory from inventory to cost of goods sold, which is an expense account. Sometimes cost of goods sold is simply referred to as COGS, C-O-G-S. So now we're looking at the balance sheet of a service company on the left and a merchandising company on the right. So do you notice any differences? The only difference is in blue. So notice the merchandising company has a current asset called inventory. So inventory, remember, is just the merchandise or goods or products, whatever you want to call it, that have not been sold yet. So this is what's sitting in our warehouse or sitting on the shelves of our stores. And let's go look at the income statement of a service company on the left and a merchandising company on the right. So on the left, the service company has a formula for its revenue, a formula for the income statement is simply revenue, service revenue, minus expenses equals net income. So now let's look at the merchandising company's income statement on the right. It's a little bit more complicated. We have sales revenue, which sometimes called sales instead of just sales revenue. So anytime we sell a product, we're going to increase that sales or sales revenue account. And then when we sell the inventory, the cost transfers from that inventory account to the expense account called cost of goods sold. Now notice cost of goods sold is separated from all the other expenses. That's because it's usually the largest expense for a merchandiser. So we take sales revenue, we subtract that main expense called COGS or cost of goods sold, and then that would give us our gross profit. For example, let's say we bought an inventory item for $100, and then we sold that inventory. So the cost of it is going to go into cost of goods sold, $100. And let's say we sold it for $300. Well, the $300 would go into sales revenue. So our gross profit would be the sales revenue, $300, minus the $100 that the item cost us, also called cost of goods sold, which would give us a gross profit for that product of $200. And then after gross profit, we subtract all the other expenses of the company to arrive at net income. So now we're going to look at the two inventory systems. These are ways to keep track of the cost of the inventory. Now, the two inventory systems that a company could choose from are periodic, which is becoming less common, and perpetual. So let's talk about periodic first. The periodic inventory system is normally used for relatively inexpensive goods. When a company using the periodic system makes a sale, they do not update inventory at that time. They update inventory at the end of the period by counting inventory. So under the periodic system, a company never knows for sure exactly how much inventory they have because they're not keeping track of all the additions, purchases, and all the sales of inventory. So a convenience store without optical scanning cash register doesn't keep a record of every loaf of bread and every keychain that it sells. Instead, the business counts its inventory periodically, which means like monthly, quarterly, or annually, to determine the quantities on hand. Restaurants and small retail stores also use the periodic system. The textbook's appendix covers the periodic system, which is becoming less and less popular because of increased reliance on computers. Now, the perpetual inventory system, on the other hand, keeps track of inventory every time we purchase inventory and every time we sell inventory. So when we purchase inventory, the perpetual system increases our inventory account, and as soon as we sell it, it lowers that inventory account. So we are perpetually updating inventory. So the perpetual inventory system keeps a running record of inventory and of cost of goods sold. That is, the inventory is perpetually or constantly updated. This system achieves better control over the inventory. But even in a perpetual system, the business must still count inventory at least once a year. The physical count captures inventory transactions that are not captured by the electronic system, such as misplaced merchandise, stolen merchandise, or damaged merchandise. And of course, when we say merchandise, we're talking about the inventory. The counting of the inventory at the end of the period establishes the correct amount of ending inventory for the financial statements and also serves as a check against the perpetual records.